So what we wanted to do at the start of 2021 is to give a bit back and put on a series of free events. So we're doing 15 events over January and February to help startups navigate 2021 in the best possible way and to really hit the year running. So just to tell you a little bit more about myself and Entrepreneurs Collective. So I am actually a lawyer by trade. Before I went into startups, I worked at a number of corporates before I decided to go a bit rogue and set up my own startup myself. Now, I didn't really know what I was doing. I set up this a dating app, and it's very different from what I'd been used to negotiating legal contracts. I had to manage a dev team, fundraise, design an app, learn to market, all these things that I didn't have a clue where to start. And I'll be honest, the first year or two were really, really tough. A lot of things went wrong, and who do you talk to? It's difficult if you've told your friends and family that you're going to do your own startup. Who do you actually talk to when things go wrong? And where do you go once I raised a bit of investment at the start from friends and family, but then I didn't have a clue where to start when sourcing investment from angels. I asked around for referrals, and I actually got some really bad referrals. We used a marketing company which we massively overpaid. They actually convinced me, I think, to take out some billboards that did nothing. Big waste of money. I had some bad referrals in terms of developers. I decided to try and address some of this by going out to some events and meeting new people. But I just found that actually some of the events in London, if it's not a Techstars or Seed Camp or one of the big events, actually were really weak. And a lot of the people you would meet would either be trying to sell to you or were people who weren't actually founders. And I just felt that there was a sort of lack of community. But being entrepreneur by nature, I got together with a bunch of my other founder friends, and we decided that we were going to raise investment and set up our own event. Next slide, please, Louis. So this is our first event, and we managed to get over 100 investors along, and we pitched our businesses, and actually we managed to, most of us managed to raise some funds. And it was so successful that I had lots of other people approaching me who wanted to do more events, and that's essentially how EC started. A little bit by accident. We were just trying to help ourselves and help each other, and that's where our sort of mission comes from, which is founders helping founders. And I'm very proud to say that every single person on our team at Entrepreneurs Collective is a founder or an ex-founder. So we're all there to help you, and we've all been through where you are at now. Next slide, Louis. In terms of what we do, we've got everything from events like this, access to mentorship schemes. We'll help you with deck reviews, fundraising. We have a number of credits and partnerships, anything from £10,000 worth of AWS, £15,000 of Stripe, and a number of other credits. Our whole sole purpose as an organization is there to help founders succeed. So, that's really, if you have a pain point, then come and speak to us and we'll try and help you with that. Next slide, Louis. So next week, we have another event which is focused on R&D tax credits and grant funding, some two really great sources of income for any startup. And then we also have our monthly pitch competition on Thursday with some really great startups. So please do have a look at these events, two really great ones there for you to join. But less about EC. If you like what we're doing, then Louis will put a LinkedIn to my LinkedIn profile in the chat. Feel free to follow me or go to the website and fill in an application form where you can find out a bit more about what we're up to. But onto our main event of the night. We're very fortunate to be joined by Bill Cogan of 7 Legal. Bill is someone that I know really well, and we've been working together for a number of years. Bill knows the startup scene and the legals around fundraising, negotiating term sheets, exit, inside out. He's the man I go to if I need advice on any of my businesses or do anything. And we're very proud to call him a partner at EC. Bill's going to be telling us a little bit about term sheets tonight. So over to you, Bill. Let's hand across.
Excellent, Mike. Thanks so much. And always great to be back at EC. I think we actually launched 7 Legal around this time last year at an EC event. It's one that I've been going to for quite a while myself as a founder. I just really love the atmosphere. As Mike said, I think you guys, in fairness, have put together a really unique community. And it really is great just for founders to be learning from other founders.
And I guess back then was when we could actually go for some beers afterwards as well, which helped.
Yes, which is always, which is, we will be there again soon.
Yeah, fingers crossed.
Hopefully. So yeah, look, delighted to be here. Thanks very much everyone for joining as well. Obviously the topic tonight is term sheet negotiation. And what we'll be going through is I'll give you a quick overview of the funding environment in the UK, both last year and what we can expect this year. And then we'll go through a term sheet and kind of what we really like to do, and any lawyer really should be able to do, is explain both sides of the table in a negotiation. So, if you're walking into a negotiation, you should understand your points, why they're commercially rational, where they are in the market, and also, the counterpoints across the table as well. So we will start. Excellent. Just a bit about us. 7 Legal, obviously we're a legal consultancy. We've been up and running for almost a year now. We're a team of 12. And really I set up 7 Legal to stop people giving out about their lawyers. I was sick of it. I was like, look, it's not that difficult. Lawyers can actually provide a decent service without everybody kind of falling out. And really where we see the mismatch there is fundamentally in a mismatch of business models between large law firms and early stage businesses. You've obviously got an asset heavy business on one side, very lean and entrepreneurial approach taken from tech startups. And, just it's a complete mismatch of business models. Where the other problems that we're solving is, of course, is uncertainty on cost is something else that people give out about lawyers. We offer fixed fees and retainers. And grown-up conversations around fees. So they're really the problems that we're solving. And who we are, we're a team of ex-city lawyers, all Magic Silver Circle or in-house practice, senior lawyers giving very stage-specific advice. And we do that from a very lean cost base. So what we can do is work with early-stage businesses profitably. So we're highly engaged with you and right through your journey. We don't see early stage businesses as a kind of a small company that kind of can be ignored. We are really stage specific, and we're really excited to be working with companies, specifically from seed to Series B. That's our space. We know it really well. We're good at it, and we really enjoy it. So that's a bit about us. What we do, funding rounds, obviously we're going to talk about here. We also help with exits. So, anytime you're putting money in your pocket is always a good thing. So we hope we get money into the company as you're growing, and then also into your own pocket as you're exiting as well. Once companies have raised cash, then we help with commercials, doing commercial contracts, terms and conditions, SaaS agreements, some data protection as well. And also we do employment and HR. So, your biggest asset in the business is going to be the talent you're hiring into the business. We can help with employment contracts, consultancy agreements, EMI and equity incentive schemes, and all your standard policies. We've also got a senior HR consultant in the team who's grown with the company, going employee 6 to 2,500 as head of people of a company of 2,500 people when she left. So, we've got advisors that have gone right through that journey from startup to exit. So what we deliver and what we can offer is what we say is legal happiness, as you can see with the slide here. And for all anyone attending tonight as well, my details are at the bottom of the slides. Reach out to me by an email. We can set up a free half-an-hour consultation. Particularly if you've got a term sheet that you're looking at or are considering funding rounds, we're available to talk to and happy to extend our time to do that. So that was a sales pitch about us. Generally about the funding market in terms of last year. Deal Room and Technation put together a really good presentation recently on these slides, just showing what happened last year with COVID and also what we can expect going forward. As you saw from last year, numbers dipped, but it still was a very, very strong year for venture capital raising in the UK. It was only topped by 2019. And overall, what we saw amongst our client base as well was, COVID hit. The world had to take stock for a while, but pretty soon after then, investment started rising again, particularly towards the end of the year. We had a particularly busy second half of the year, and that's reflected in the numbers here. As a general trend, what we did see was a decline in seed deals. So the earlier stage deals are actually going down in numbers, but mega rounds and later rounds are increasing both in deal numbers and deal volume. So it's something to be aware of. There is more and more cash being raised, but the actual money funneling into companies is looking at a higher concentration in fewer companies. So less companies raising more money, even at the earlier stage, is a general trend. We're seeing it both in the US and Europe. So it's something to be aware of. Where that goes next, we'll see. Good news for anyone who's based in the UK. If you are raising money in Europe, European VC funds are disproportionately centered in the UK. You can see this by the size of the funds and the amounts that are being raised by European funds. It is, highly concentrated in the UK. It's more than double and triple Germany and France, and bigger than the whole of the rest of Europe. So if you're UK based, fantastic, good news. Again, in terms of UK companies, they're also raising more cash. So both the VC funds and UK companies are raising a lot more than even, as we can see here, much more than Germany and France, and right up there with the rest of Europe combined. So again, if you're looking for VC cash, good place to be is London, the UK. And if you are then looking for your VC funding, who will you be raising it from? As you guessed, UK-based funds are probably going to be the funds that you're going to be raising from, particularly at the early stages. As later stages, as you develop towards more late stage funding, USA and Canada and North American investors become more and more prominent. But at the early stage, it is predominantly UK investors where you probably should be concentrating your money on. I saw a recent statistic put up, though, just to temper that if you do have a US investor on your cap table, the likelihood of raising much larger rounds and also exiting at valuations is actually exponentially higher. So it's certainly something to take into consideration. If you can raise from a US VC, statistically speaking, if you're able to do so, you will be more successful in terms of raising larger rounds.
On that point, Bill, just to weigh in with some anecdotal, I've come across a few startups who I know really struggled in the UK to get investment, but then went to the US and really sort of nailed it quite quickly. I think especially in the big idea, very ambitious, aggressive sort of, world vision type companies that maybe don't go down so well with the more conservative UK investors. I've seen a few times they take a flight over there. Actually, and that's included, a few startups that I know were struggling here, and they went over there and then raised, really big investment rounds and at valuations, which frankly, as you said, dwarfed what we were seeing in the UK.
Yeah, and look, I think, anecdotally, and I think if you look at the stats in terms of kind of what US companies raise versus European companies raise, it's borne out there, certainly. And, I think it's where entrepreneur networks like this become even more important, because, we all know it's tough raising in the UK where you have your network. If you are going to get on a plane and go to the US, you need that network pre-warmed up by your connection through organizations such as the Entrepreneurs Collective and any other contacts you can put together So that was kind of a snapshot of what we kind of saw last year, what's been happening. And like I said, it's kind of broadly reflective of our client base as well. In terms of the year ahead, given where we've seen how much cash is flowing into VC, what we can see here is there's a lot of dry powder to deploy, both from that, slight decrease investments last year, but also the amount that's actually being flowing into venture capital funds. So if you're an early stage technology business and you're in the UK, now is a good time to get out there and get raising. So that is a summary. So once you have, gone through the process of speaking with investors, getting around together, obviously the next step that gets presented is your term sheet. So term sheet is a non-legally binding document. It's usually anywhere between 3 to 5 pages, I would say, plus some schedules. And what it does is it summarizes really the most important points of the entire structure of the investment or the funding round that you're going to go through. So I always say it's probably the best value you get out of a lawyer, because you are really negotiating the key commercial points on a very slimline document versus the long form documents that are going to come behind. So really can emphasize how much concentration you should put into your term sheet negotiation, and really get good people around you that have experience in doing this. What we see oftentimes is either founders will come to us and say, oh, we've actually we've got a signed term sheet, so we'll just negotiate the term, the structure of the round now. And that's not how it happens. Like, all of the negotiation is done at the term sheet stage, and you really need to be on it really even before you're presented with a term sheet. Know the negotiating positions you're going to go through, and be prepared for those conversations. It makes you look more sophisticated. It'll make you more confident in those negotiations, and fundamentally you want to be in the driving seat in those negotiations as much as you can be. So we'll take a look. So this is effectively what the structure of most term sheets look like. And there's 3 lenses that are, you can pick up a term sheet and look and review them through. In terms of the economic terms, how's money going in and going out, the control terms, what control provisions the investors are going to put on the company post-investment, and then administrative terms. So the way you look at that is kind of, they're kind of by the by, they're something to negotiate, but don't be distracted by the administrative terms when the real meat of the negotiation is on the economic terms and the control terms. Something to be aware of. This lens is not my own creation. It's based on a book called Venture Deals by Brad Feld and Jason Mandelson. Brad Feld is the guy who started Techstars. So it's written by 2 VCs. It basically tells you how they negotiate venture deals, and then they also give insights from entrepreneurs who've been through this process as well. So it's an excellent book. It's never far from, it's actually here, just to prove. It really is the Bible. If you're ever raising investment, then read that book or attend this workshop, whichever you like. So we'll go through each of these points as you go through, but remember those terms: economic terms, control terms, administrative terms. So the first thing you'll be looking at is how are you actually taking money into the company? Is it by debt or is it by equity? And what type of security will you be issuing to take on this cash? So typically, most early stage UK companies will start off with an equity round. So you'll be issuing, fresh shares will be issued by the company in exchange for cash from the investor. And the shares in the company will fall into 2 broad classes. First of all, you'll have ordinary shares. So if you've incorporated in the UK, you'll most likely have just been issued with model articles, incorporated the company, and you'll have ordinary shares. So the ordinary shares have equal rights to voting, dividends, and a right to participate in a distribution of capital when the company's wound up. So kind of everyone's on equal footing, effectively equal footing. Preferred shares then would typically come in when an institutional investor is coming on board into the round, and these are shares with enhanced rights over and above ordinary shares. So that might be enhanced rights in terms of voting. It might be have enhanced return rights in terms of participation, which we'll come on to, or anti-dilution protections, again, which we'll come on to a bit later. So ordinary and preferred shares. Ordinary shares, very early. Preferred shares, typically when you have your first institution come on board. One thing when looking at ordinary preferred shares is to consider SEIS and EIS. I presume that everyone is aware of the SEIS and EIS. It's effectively amazing tax breaks that investors can get for early stage technology companies in the UK. It is a source of great jealousy for any founders who are outside of the UK, or and a lot of jurisdictions are actually looking at implementing this now in their own tax structures. You know, to be honest, I don't think a lot of us would actually be sitting here this evening if this tax break wasn't in place. One very prominent UK VC referred to it as the most innovative thing to come out of the UK in the last 25 years. So, you know, that is how important it is to the UK technology sector. It's an amazing tax break, particularly for the first couple of rounds into a company. So if you don't have SEIS or EIS advance approval and you are eligible for it, I would recommend doing it, particularly if you're raising from angels in the first instance. But what this also does is it means because the HMRC is giving these incredible tax breaks to investors, it also says, as investors, you need to be putting your capital at risk. So anything to de-risk the investment is viewed very negatively and can disqualify investors from SEIS and EIS. So something to be aware of. The other type of way of getting cash into the company would be by way of convertible loan notes. We've seen this kind of more and more now with the Future Fund, the government's fund to support early stage businesses launched in light of COVID. What this is it's a loan with a coupon that can be converted into shares at a later date. The conversion would typically be you know, at the next funding round or a long stop date in the future. And you'd normally see a discount applied at the point of conversion as well. So the rationale here was these started in Silicon Valley as a way of getting cash into companies very quickly and avoiding high legal fees. And the rationale, so instead of negotiating a full investment round with investment agreements, articles, arguments about valuation, etc., this is simply, you know, a much shorter document and says, hey, here's the money, we'll take it as, we'll put it in as debt and we'll convert it the next round. Very simple, and is used, you know, it's used very widely for non-UK investors, mainly because you can claim SEIS or EIS, those tax breaks we mentioned, with debt. So simple as, if it's a convertible loan note, it's not seen as much in the UK. What you would use in the UK is an advanced subscription agreement. So this is very similar in that it's a convertible, but there's no debt element to it, i.e. It's again a very short form agreement saying me as an investor gives the company cash now, and the company will give me shares at a later date. You know, again, subject to a long stop date, potentially with a discount applied as well. Rationale there being it's quick, it's easy, cash into the company, very little or no legal fees, and you know, you crack on until your next investment round. They're generally the kind of ways that you're going to take on investment if you're an early stage UK company. The next factor that you'll be negotiating, or a piece that will come up, is around valuation. You know, there is no clear-cut definition of how you can value an early stage company, particularly pre-revenue. Some of the factors that you'll look at, or an investor will typically look at, is, you know, what stage is the company? Who are the team? Is this, you know, seasoned entrepreneurs that have been around the block 2 or 3 times, have raised capital and sold business previously, or is this someone, you know, who's fresh out of college, maybe hasn't done this before, is starting out their entrepreneurial career? Is the company revenue generating? Both in terms of numbers, you could look at both the financial numbers, but you could also look at growth metrics as well. What's the funding environment generally? The economic climate, is there a lot of heat in the market? And you know, even within the company itself, is there a lot of competition to get into the cap table amongst varying funds, for example. So, these are all factors that we'll look in. One thing I would say is, compared to 5 or 6 years ago, there's actually so much more data on companies available now in terms of, where they're raising from, how much they're raising, at what stage. Companies, platforms like Bohurst, TechCrunch, Deal Room, etc. These are all additional ways you can benchmark yourself against your peer companies and, really build a rationale and an argument for your valuation. So, use all those factors, but it will be a range of factors, I'd say, that will determine valuation. But if you can rustle up a lot of competition to get in on your cap table, it's probably the best way of doing it. So the next part of the term sheet will be the purchase price or the share price. What are you as a company selling the shares at? And that's very easy to calculate. You take your pre-money valuation and you divide it by the fully diluted share capital immediately prior to completion. So fully diluted share capital means all the shares that have already been issued, say to you and your co-founders or to existing shareholders, and then you add in everything that could convert into shares. So again, the convertible loan notes that we mentioned, advanced subscription agreements, the option pool is a big swinging factor, which we'll show shortly. So everything that can be converted into shares goes in here at that point to get your fully diluted share capital. Your post-money valuation, very easy to calculate. You take your pre-money valuation, add in the cash that you've raised, that'll give you your post-money valuation. If you want to calculate how much dilution you're going to face in a round, there's always a bit of confusion around this. What you take is the amount that you have raised in the round and you put that over your post-money valuation. So if you raised 1 million and at a 4 million pre-money, you've raised 1 million at a 5 million post-money, you've taken 20% dilution, not 25%. So bear that in mind when you're calculating that. There's plenty of platforms out there as well to calculate your cap table as well. So the next kind of factor that you're often asked, and it's something that we saw on a term sheet this week actually, is around staggered financing, and that's where investors will propose splitting an investment into tranches. So instead of if you're out there raising a £3 million round, an investor will say, great, we'll do the full 3 million. Here's the valuation, but we're going to split out that investment into a couple of tranches. What you need to be aware of here and be mindful of is that this obviously de-risks it from an investor perspective. They're not cash out, happy days. What you need to be very careful of is that the milestones that you're agreeing to, if you do agree to staggered financing, these need to be very clear cut and also easily achievable from the company perspective, because what can happen is if you're not hitting those milestones, is you back yourself into quite a difficult corner in that cash will hit, head down, trying to hit the milestones, burning through your runway. If you're getting to the point where you're going to miss those milestones, it's a very difficult conversation because one, you've got no negotiating position with your investors. You're saying, look, I promised to do something, I'm not hitting that. Two, if you do need to go and raise, you're going out to the market saying, hey, we've raised this cash, our current investors are not backing us, and do you want to invest? Again, not a great look. So be very careful about taking on the staggered financing. Make sure you can hit the milestones, they're easily achievable, and don't back yourself into that corner effectively. So be very mindful of it. Now, one way, if you're fairly risk on and you're very confident in your approach, what you can turn around and suggest is, hey, look, all right, if we hit these milestones, you as an investor are obviously getting a more valuable company because we've taken the capital, we've deployed it, we've hit milestones that have now made the company more attractive. So let's increase the valuation if we hit those milestones. And then that way it's a good balance of risk and reward on both sides, because you've de-risked the investment, you've increased value. So from a company perspective, why not? One point, so that's staggered financing. It's something that comes up now and again. One other point to kind of come back to the fully diluted perspective is in terms of option pools. Often you'll see investors will push for larger option pools than maybe you think are necessary. What's happening there is effectively a decrease in your valuation of the company, because the pre-money valuation, if that's taking into, say, a 10% option pool, that's effectively saying you are going to give the investor additional 10% of shares on the assumption that those options will be issued. So it's very important to understand that that mechanic in terms of how you're being affected by the dilution there in the option pool. So from existing shareholders' perspective, and typically, at the very early stage, that's the founders, you want to make sure that that option pool is, limited as much as possible, because you're effectively taking all the dilution on that. The arguments for and against that are, effectively what you'd say to an investor, or what you'd approach it around is you'd be approaching with the thought process that, look, here's my hiring plan for the next 12, 18 or 24 months, however much runway you are raising. If indeed you are giving away a lot of equity, like if you're paying market salaries, you may not feel the need to give away much equity. Really, minimizing the dilution that you're taking until later rounds when that can be shared across further investment through more shareholders is a wise move if you can do so. So again, going to that negotiation with a hiring plan with both salaries and equity mapped out, again, gives you a lot more logical footing to negotiate on with the size of that option pool. Over the last few years, we've probably seen option pools drop more and more. I think, as founders have become more savvy and seen what one founder referred to the other day as the option pool shuffle, or the share option plan shuffle, which I thought was quite funny. So yeah, it's something to be aware of. We're kind of seeing probably, anything from 5 to 10% around now, whereas before it would have been kind of 5 to 20 or 10 to 20. So something to be aware of again. Next factor that you'll be looking at, or the next clauses that you'll be negotiating on, is preemption rights. Not too much to negotiate around here. Preemption rights on an issuance of shares is effectively giving all your existing shareholders the ability to participate in subsequent rounds. So typically the way that's drafted is everyone on the shareholder, or all shareholders, will have a pro rata entitlement to participate in subsequent rounds. Makes complete sense. If you're an existing investor, you want to invest again in a company, it makes complete rational sense. One thing to be aware of here, and something to keep in mind of, is obviously if everyone gets their pro rata entitlement, the founders typically won't invest. So there's a large chunk of pro rata rights that are left then available. Really, what you want to make sure here is that the board is in charge of the allocation of shares over and above the initial pro rata entitlement, and what that leaves retains control with the management team as to who's getting the chunk of the next investment round. So again, something that gives you control over who comes onto your cap table, and also it gives you control of how much of investment you'll be taking subsequently from your existing investors as well. Again, retains control. Same thing with a sale. Typically, very typical rights here is that if anyone were to sell before any shareholder across the shareholder base, if they're going to sell, then typically they'd be required to offer those shares first to the existing shareholder base pro rata. Again, most early stage companies are closely held, so you want it, again, makes complete sense there. That's preemption rights. So liquidation preferences you're coming into the more sophisticated institutional investor style protections here. Again, these wouldn't be available for SEIS or EIS investors. So at your first maybe round, or maybe your second round, you probably wouldn't see these type of clauses if you're just raising from angels or SEIS or EIS funds, indeed. But a liquidation preference then comes in, typically where you've got a VC on board, you've got an institutional investor on board. And the way to think about a liquidation preference is it's who's getting first slice of the pie. So who's getting, when you do see a liquidation or an exit, who's getting their money back first. And investors oftentimes will say, hey, look, we have put hard cash in, we want our cash out in the first instance. Again, perfectly reasonable rationale for that. And there's a couple of ways of doing this. So there's participating and non-participating. So non-participating would be where an investor would take either the cash that they put in or the percentage entitlement they'd be entitled to based on their shareholding. So it's either or. So you take either the cash out or your percentage entitlement. Now, the way this works is effectively once you're exiting at larger than the post-money valuation of the original round, then this becomes a moot point because an investor will always take their percentage shareholding. So in the example here, we said, all right, you're taking out 1 million investment at a 4 million pre-money, giving a 5 million post-money. So again, 1 million over the 5 million post-money gives 20% dilution. So if the round was 5 million, or say, for example, the round was 4 million total on an exit, the investor would obviously take the 1 million return rather than taking their percentage entitlement, which would only be 20%. So they'll take the 1 million pounds back. It's downside protection because ultimately you've raised and sold at a lower valuation than what you've raised at. The participating liquidation preference is, the one most people want to, or most companies want to keep an eye out for, which effectively is saying, all right, we're going to take both our investment plus our percentage entitlement out. So I'm going to take the 1 million pounds back, which I put in, plus I'll take 20% as well on top of that, which, at the lower valuations is, fairly damaging, I would say, for all other shareholders. So what you want to be very aware of is keeping an eye out for these liquidation preferences. Market standard would be 1 times non-participating. So, it comes back to that either or scenario. And, that is something that is pretty much very, very standard really amongst most VCs. We had a founder last year who had a term sheet come in. They had a participating liquidation preference. We were like, when we were advising them, we said, look, that's off market, probably wouldn't recommend it. And what we did there was actually, go around our network of founders and speak with who's out there, what are they seeing, just to make sure that, the market hadn't moved. Were we missing something? Again, that confirmation came back and said, no, look, this is off market. Founders walked away from the term sheet. They said, no, we're not agreeing to that. Fortunately, the company was one that was able to raise another term sheet. But again, having advisors in the space that know the space is really important. So I'd highly recommend with any advisor, accountants, tax, lawyers, make sure that you're getting stage specific advice, so people who are in the market and understand what's going on. So that's liquidation preferences. Anti-dilution. So this is a compensation for investors in the event that a down round were to occur. So a down round happens where a company raises at a certain valuation, and then for whatever reason, they have to go out and raise at a lower valuation than their previous round. It's called a down round. The rationale for anti-dilution is effectively that, it's compensation to investors who invested at a higher valuation and are now seeing, their share price fall and potentially negative return. Again, there's a couple of ways to do this. Some are, I think more fair or equitable. Some are more sharkish and will, set the hairs running if you see it. And what they are is, there's a couple of ways of doing it. A full ratchet is effectively says that, as soon as you hit a down round, we are completely repricing the previous round. So if you come in, if you do a funding round that's £4 a share, the next round is £2 a share, we are completely repricing the previous round to £2 a share. Now, what that does, it's highly dilutive from the other shareholders' perspective, because you're taking dilution from the down round coming in, i.e. the new investors, but also you have to go back and take dilution from the previous rounds investors. And this is triggered even if you're raising a much smaller round. So it can be exponentially damaging for founders and something to be very aware of. Again, we saw it in a term sheet this week. We've pushed back very strongly on that. Again, said it's off market, and a much more balanced way is doing a weighted average. The weighted average looks at what the two rounds are, but takes into account how much you're raising. And instead of repricing the whole of the round, there's a formula to balance that out. So you kind of keep in mind that you've got that the previous investors may not be completely wiped out by this incoming round. It may be actually just a small round that we're trying to get to a bigger round down the road, for example. So less punitive, a bit more equitable, and more balanced. I think most investors will probably agree that that's a much more balanced way of doing things. One other way you can discuss and negotiate and comes up in term sheets is the pay to play. So effectively what this says is that either your preemption rights or your subsequent or your preference rights. So for example, the anti-dilution, they only survive each round if you're participating in each round. Or, so effectively, if we looked at that anti-dilution scenario, what we'd say here is, okay, we'll give you anti-dilution protection, but if we do have a down round, in order to get that protection, you as an investor should participate in that round. And what that means is that it's a signal to the market and says, actually, we still back this management team. We're still willing to invest, and that'll make life easier for management. They'll be able to point to, hey, look, our existing investors are still willing to back us. You're getting a bit of a bargain here in terms of down round. Come in and come into our round. On the flip side, if you as an investor aren't willing to back us in that situation, then you lose your protection, because ultimately you've actually damaged us by not coming back in. It's a negative signal to the market, doesn't play well, so you lose rights. So again, pros and cons, there's rationale both sides there, and it's something to balance with each round and each negotiation. Moving on then, drag along. It's very well known phrase. Effectively, the drag along allows a majority, typically 75%, but you'd review the cap table at each round and say, okay, what is the drag along percentage we should be looking for? And that's the ability of that majority either to force a sale on the rest of the shareholders. Now, where this needs to be balanced through the different rounds is, early on, typically the founding management team may have over 75% for the first couple of rounds. So they'll be able to, hypothetically drag investors or drag the rest of the shareholders. The rationale for it being that, if 5% of shareholders don't want to sell, 95% do, then the 95% shouldn't be held hostage by a very small minority. Which, again, makes sense. Ultimately, any purchaser of the company will want to buy 100% of the business. So it's an important clause to include in order to avoid being held ransom by a minority. From an investor perspective, if they're only, if you're an investor, you're coming in, taking 5% of the company, your rationale here is, well, I don't want to be dragged because I put in hard cash here, and you told me that you're going to, as a management team, are going to, scale this to the moon. So if you're selling out early, then something's gone wrong, and I want to make sure that I'm getting my money back. Again, you can see the rationale there. It's perfectly reasonable. So, where typically you can get in negotiations is say, okay, well, how can we align our incentives here in terms of, right, is there a way that if we reach a certain valuation, can we as the management team get control of that exit back? So, i.e., once we hit a 10 or 2x, 3x, 5x return for you as an investor, then we as a management team should be able to drag at some point in the future. Again, investors will take this on board. It's always a negotiating point. And angels are very, angels generally don't mind. As you kind of get into more institutional investors, this can be a point that can be heavily negotiated. But again, I think it's always an interesting one to engage with anyway, because you can find out what your investors are looking for in terms of return. So you'll know that, all right, 2x won't do it, 3x, yeah, look, we're probably looking at potential exit opportunity there. It's a good way of getting to know your investors. So yeah, and that's how effectively it's done, is that above a certain valuation, the investor would no longer be part of the dragging majority, and the gloves are off. As a general point, I would say that if your business is reliant on raising more capital, going into any investment round, I'd always make sure that you can raise more capital. You see it quite a lot when we pick up documents on a second round from previous rounds or companies that have been advised elsewhere. You'll see in very early stage investors putting in limit or a blanket ban on raising more capital, which is I just think crazy. Going into any investment round, I feel like you should always be asking yourself, can I raise more money if I need to? And two, can I eventually exit? Because in a lot of instances, if the game plan is raise multiple rounds and exit, you want to retain as much control in doing so as possible. Again, can I raise? Can I exit? Two very easy questions going in, tougher to negotiate as you go through. So tag along then is the inverse protection for minority shareholders. So we had the majority dragging a minority. The tag along then is the inverse, where it says actually we as a minority, if you're selling the business, we want to participate in that sale. So we don't want to be left behind. We can tag onto the transaction. So typically you'd look at, and the concern here would be that, say, the two founders just decide to sell 51% of the business. They're checking out, going to take a good payday, leave the business, and leave the investors on the shelf with no return. That's also the rationale there. So tag along is that protection and says, look, if you're selling a controlling interest, then that deal also needs to be offered to the minority. So tag along and drag along, they're two of those phrases. So the control provisions of the deal. First thing, oftentimes the most important thing is what's happening founders' equity. So share restrictions and vesting is something that's looked at on every round. People say what's standard. I would say it's one of the most hotly negotiated areas. Every investor has a different take on it. Every founder has a different take on it. And it's different both for the founders and the senior employees, as well as the junior employees within a business. So, you really need to dig into what's the rationale around vesting. What happens when you do vest? Are they then your shares? What happens then when you leave with your vested or unvested shares? There's a kind of a series of decision points to make. And like I said, a lot of people have different views on this. A fairly standard structure that you'd see quite a lot is a 3 to 4 year vesting period with a 1 year cliff. So a 1 year cliff would be an initial period during which if you were to leave, you'd lose all your shares. That's that initial 12-month period, after which the remainder of the shares would vest in monthly increments. So say a 3 year vesting period, a 1 year cliff, 0 to 12, you get 0. At 12, or once 12 months is done, 1/3 of your shares will have vested, and then they'll vest in monthly increments for the preceding 24 months. So that's the way to think about it. Where the back and forth, where you get back and forth in terms of negotiation here is one, if you have already worked in the business for several years, you'd really want to have that time recognized. I would suggest, typically that would be, so you'd look at, okay, first of all, what percentage of your shares as a founder you're willing to put up for vesting. So, if the suggestion is a 4 year vesting, well, if you've already been in the business for 2 years, then you'd say, okay, well, look, 2 years I've already vested, then we're down to 50% of the shares, 50% of my shares that I'm willing to put up for vesting. Again, and then you'd say, well, look, we're not having 12 or 1 year cliff. let's just put in a 24 monthly vesting. That's it. The next question then will become, okay, well, what happens to the shares that are vested and unvested? So, typically as a bad leaver, if you were a bad leaver for cause, you'd lose all your shares. That's fairly standard. It's within your control not to rip off the company. Fair enough. And then you'd have different approaches then to actually, okay, what about your vested shares if you were to leave? Are they sold back? Are they converted to deferred shares or given up? Are they sold at fair market value? Again, not always an easy way of doing it. You could offer to your investors to buy. Typically, they're the only ones who have deep enough pockets to do so. They could be kicked into an option pool for an incoming CEO or management team. Different ways of doing it, and a multitude of options, as you can see from just these are just a few examples off the top of my head. So again, it's something that's highly strongly negotiated, and you really need to look at the rationale behind those decisions as you're negotiating them. Personally, I think if you vested your shares, you should be able to keep them. It's just my view. You put in the work, keep the shares, and anything unvested, either kick back or convert. Again, it really is a personal opinion, both between you and the investors. So veto rights or reserved matters, it's something that you'll see and will be negotiated in the term sheet. Oftentimes you'll have a kind of a high level list in the term sheet of things that you as a company will agree not to do without an investor consent or an investor director consent. These are typically at an early stage, they'll be quite limited. As the company grows and is getting more complex, the list of these actions will also grow. So, an angel round will look quite simple. Don't do anything that effectively you're going to rip off the company or rip off the investors by doing. As you get more sophisticated, these lists of consents get more sophisticated. So, things like, okay, we won't issue new shares. Again, that for me would be a red flag. Do not give up that. Any changes to the share capital. So you wouldn't enter M&A, for example. You wouldn't start going out and buying other companies. The rationale there being that an investor will come to you and say, I believe that you can build technology. If you're a technology founder, I know that you have your skill set. I've done due diligence on you. I'm convinced that you can do that. I don't know that you can conduct M&A activity with the funds that we're giving you, so we'd rather you just do not do that and come to us for consent if you need that. And then it's going to be a predefined list of actions that you can't do unless you have investor consent. Most of them make sense, to be honest, when you kind of go through. Obviously, you had a lot of experience negotiating with founders. Sometimes the list looks very long, but when you go through them individually, you kind of say, okay, yeah, fair enough. A lot of these, once they're not impacting on, again, raising more money, you operating the business, there can be flexibility here, but just knowing which ones to give and to push back on is important. Management, then, what does the board look like? I've said it a couple of times here about stage-specific advice. What you really want to be careful of is giving away board seats very early on. So you don't want, if you get up to Series CDE level, that you for some reason have given away this entrenched right to an angel investor who's still sitting on the board and may have had no experience of actually advising companies through a hyper growth stage. It just doesn't make sense. So when you are giving up board seats, make sure that they are linked to either a minimum shareholding within the business, so that as the rounds go on, each appointment right gets diluted and those board seats fall away. And that's really to reassess who is on your board at each stage, who's going to be the best position to advise you through each stage of growth. And so that, from a founder's perspective as well, so that you try and retain control of the board for as long as possible. So, probably through the first 2, 3, potentially 4 rounds, you probably need, you don't need a huge board. You typically, particularly as directors, you can set up advisory boards if you need specific advice, but, from an early stage perspective, you really don't need that many seats. Plus, it'll cost you money as well. Investors will have to charge you for putting on investor directors, etc. So, you know, keep your board tight and make sure everyone in the room is giving you high quality stage specific advice. One way of you know, balancing people ask for board seats is you give up an observer seat. Observer is effectively someone who can attend meetings but is not a director of the company, has no voting rights, has no authority in in rooms. You know, I always say still need to be mindful of that. You know, someone in a room can still influence, can still be disruptive, can still have sway. So again, you know, be mindful, I would say, and make sure that anyone who's coming into the business is adding value and will add value through each stage. Something to be aware of, and again, tied to a minimum shareholding makes sense. Employee share option plans, you know, you typically have to commit to putting in place an ESOP, normally within 6 months of completion. Typically founders are excluded at the earlier rounds as cap tables get more diluted. You know, later stage investors will say actually founders need to be topped up out of the option pool or by grant of equity. So earlier, at the very early rounds, you wouldn't typically see founders there. It does come in later rounds. It's used as an incentive to attract talent or incentivize existing talent. What I would say is, you know, often we'll see what can happen is, you know, chunks of equity are given away very early to kind of early team members that then aren't around for subsequent rounds. And it can cause an imbalance in terms of you're bringing in more people at a later date who are then sitting on less equity than very junior staff. It leads to headbutting, etc. So, you know, I'd just be mindful when you are awarding options that you feel that those individuals are going to be there for the journey and are there for the long term. And, you know, you can incentivize that by vesting or KPI driven allocations in terms of options. EMI options are the most tax efficient way of granting equity in early stage businesses. You know, we can put them in place and happy to have a chat on those. And, you know, the founder note again here is just be mindful that if you are putting in place an option pool, typically at the early stage, you are taking the dilution. So make sure that that option pool is size specific and is appropriate. You know, it's unnecessary to put in place a huge option pool earlier on, particularly when, you know, you don't know if you're going to use it or not. The administrative terms of the deal. So we've been through the economics, we've been through the control terms, admin terms. We can, you know, blast through very quickly. You know, what are these typically that you'd see in a term sheet? The information rights. So, you know, what are your reporting functions to your investors over the life cycle of the investment? Earlier on, we'd say quarterly is perfectly reasonable. You don't want to become a cost or an admin function. An admin burden to the team. You're busy running the business and trying to grow as fast as possible. So don't sidle up that necessarily. Like I said, quarterly is perfectly reasonable. Some funds will request monthly because they have to report up to their LPs, or GVs. So be mindful of that. You know, some funds will just come back and say, no, we need monthly. If that is the case, make sure that they are very easy reports to pull off Zero, whatever your accounting software is, whatever those KPIs are agreed with, just make sure that they're very easy to do. You'd also need to commit that the funds that you're raising will be used in accordance with the business plan or the model that you've presented. So the use of those proceeds are as agreed. Typically, you'll need to start putting in place key man insurance over both the management team plus any investor. Director coming onto the board will demand directors and officers insurance. Very easy to source. There's plenty of brokers out there. I understand Hiscox is fairly easy to arrange via. Founder employee. So you also at the stage where you're taking on you know, institutional funding or, you know, maybe a larger angel round. You know, you will be asked to enter into employment agreements, the IP assignments, and also your non-competes will be reviewed at each round to make sure that they're all on point. Also, anyone who has ever worked in your business and created IP, make sure that you have IP assignment clauses in your consultancy agreements, employment agreements, any third-party software developers, just, it's the first thing that we looked at in due diligence by an institutional investor. So make sure that you've got that set up and in all your contracts. In terms of data room, we've actually set up, we've put together a guide on how to put together a data room ahead of a funding round, plus a folder hierarchy. It's based on Y Combinator's recommendation. If anyone needs that, just reach out after. We can circulate. Very simple. It's just, get your house in order, and it'll make things a lot easier, because at the point where you're negotiating a term sheet or your funding round generally, you don't want to be rushing around looking for, an option agreement for someone who's, backpacking or whatever. It's just like, look, keep it in order and keep the admin very simple. And then the last thing to consider would be the warranties. Warranties are statements that you'll be making about the company at the point of investment. If they're proven to be wrong or false, there is potential personal liability if the warranties have been given by the founders. So you need to, review them, make sure they're tightly drafted, make sure they're, relevant, make sure that they're accurate. If there's anything that is about the warranties that you need to make a disclosure against, disclose, make sure that you give a full and frank disclosure. And it's really with a view of putting the investors in full knowledge of the state of the company at the point of investment. Typically that's around share capital, business plans being created some way reasonably. There's no IP claims or anything, any litigation outstanding. All pretty straightforward stuff. Again, very simple at the early stage, gets more detailed as you go forward. That's all the admin items. And that is actually us, guys. So we've rattled through what a term sheet looks like, what the negotiating positions are typically taken from the company and the investor side. And my details are here. You can click on, or I think we'll be circulating the slides. So you can book a Calendly invite there. Or drop me an email, or I'm on LinkedIn as well. So that's
okay. Great stuff, Bill. Went into some brilliant detail there, and some great questions were popping out. I know we're a little bit over time, so before we delve into some questions, just to reiterate to everyone. Obviously, Bill knows this area inside out. He works with startups and scale-ups. If someone like Bill is offering you the opportunity to get a 30-minute free consultation, I would be very much looking to take advantage of that if you're considering doing any fundraising in the near future. His contact details are there and in the chat as well. So just drop him an email and just put regarding free consultation at the EC event, and I'm sure he will help you guys out. So I'm conscious that we're a bit over time, so I know some of you will be dropping off. But let's move to take on some of the questions that we have. So I think some of you guys may have left, but we'll go through them.
None of the hard ones, though, Michael.
Right. Okay. There's quite a lot of questions. Okay. Do you think online legal platforms are disrupting traditional legal practices? Okay, one at the core of your business.
Yeah, absolutely. I think some of them, I think the biggest one that we all know about is Seed Legals. I think they are a really good platform. I think they're, obviously solving a problem that a lot of people have, which is access to legal advice. Where we see, the advantages of is, you can get on there. It's very good in terms of, I think it's really good if you're on the rails, i.e. you don't have any legal questions, you don't have any departures. And the departures from very standard forms, that's where we typically get our clients come to us. Well, we're typically kind of one stage on from Seed Legals. It's where you've got like a sophisticated investor on the other side, and you need to dictate the terms. And the reality is that investors dictate the terms for the most part. So I think it's great, and I think it's anywhere that people can get an understanding of how to do funding rounds and get investment on is brilliant.
Yeah, and I sort of agree with Bill in that you know, some of our members have used, you know, seed legals, and it's all well and good. If it's a straight transaction, very simple, you know, angel investor, you know, 10, 20K, anything like that, then, you know, for sure, seed legals does the job. But, you know, as I say, the main issue is if you need to think about how your round will come together before you start using seed legals, because we've also had the other option where people have started using seed legals, realize that it doesn't cater for the complexities, and then they end up paying for seed legals and then having to hire a lawyer on top of that. So
yeah, that's where we've come in a number of times. And yeah, look, I think they're really good. And to be honest, like, you know, that's what effectively what we're doing. We try to just implement legal tech as much as possible so that we're super efficient on our side, but you still get a lot of lawyer time. So, yeah, and actually, to be honest, the pricing actually isn't that far off what we do actually when you break down all the kind of different elements. So yeah, I think it's a great way of I think it's disruptive, and it's, you know, got plenty of ways to go too.
Yeah. Okay, another question for you. No. Okay. Oh, Alex wants to chat to someone on how to raise a VC funding round. Okay, so yeah, Alex, I'd reach out to Bill. I'm sure he can cover that in his 30-minute consultation. Danny asked, what is the best US fundraising platform for UK fintech businesses to raise funds in the US?
I haven't a huge amount of experience with platforms in the US, to be honest, but we do have a US firm that we can refer to stuff fairly recently. So, quite a bit. So feel free to reach out, and sure you can.
Yeah, I certainly have. We have some contacts for EC as well in the US, and some US actually, we have a couple of US VCs that attend our pitch competitions as well.
I think though, in terms of, I think just before going off that, is that actually, like, the UK is seen as a fintech leader in terms of VC investment. So, you know, before maybe going to the US, I'd probably try to speak with as many UK fintech VCs here as possible.
Yeah,
that's helpful.
And yeah, I think and we work quite well at EC, connected with a few fintech specialists. Augmentum, I think, is one, and what's the other one? Yeah, but I think there's a couple of others based in London who specialize just in fintech, and those guys are worth chatting to. If you want introductions, reach out to me. Okay, there are people asking for your data room structure, Bill.
Gotcha.
That will be,
yeah, we'll circulate that.
Yeah. Right. Another question: are options pools funded by existing investors, or are you asking new investors to fund the option pool?
In terms of, so typically an incoming investor will insist that the option pool is put in place before their money comes in. So, you know, it's everyone is taking dilution. Sorry, everyone up to the point of that new funding round is taking the dilution on that. So it would be, if it's the first round, if it's just the founders, then the founders are taking the dilution, at which point the investment comes in. At the next round, you'd have your two founders plus your existing investors. They would take the dilution for the new investors coming in, insisting on a bigger round. So you kind of get hit there at each round by potentially a top up to the option pool plus dilution of the money coming in as well. So you can see you need to be aware of those two dilution levers, which is your pre-money valuation, i.e. how much your dilution you're taking for the money, plus the dilution from increasing the option pool, if that is required.
Yeah.
So I guess existing shareholders would be the answer.
Yeah. Another question from Nirosh. Hey, Nirosh. How do ASAs comply with the SEIS requirements?
So the ASA is effectively an investor giving cash in exchange for equity. So they're, promising, effectively, it's like, hey, here's money, company, you will give me shares at a later date. At no point can you can an investor demand repayment of that cash, because that would effectively become a debt. A debt is not compliant with SEIS or EIS. So once the advanced subscription agreement, I believe there's a 6 months restriction potentially around conversion. So they need to be converted within 6 months, I think, from memory. We don't give tax advice, so I'll just caveat that. But effectively, that's it. It's an equity investment rather than a debt investment is the main thing to remember on advanced subscription agreements. And then the investors can only claim the relief once the shares are actually issued. So a lot of times investors coming up to the end of the tax year will insist that their shares are issued. So just bear that in mind as well.
Okay, managing cap table. Someone suggested Carter here. What are your thoughts on Carter?
I haven't used Carta. It's very big in the US. The UK versions, such as CapDesk, are the kind of European version. We know the founders over there. I'd recommend using them. I think I might even have a small slice of equity in it. So I'd recommend that completely. I think that really comes in when you're managing quite complicated cap tables. I think actually a lot of early stage companies could do with just logging on to Inform Direct, which is just.
I was going to say that's what I use as Inform Direct. It's super. It APIs to the company's house. For a basic cap table, it's really good. If you want to issue shares, it takes 2 or 3 minutes, and it takes 2 hours to register with the company's house and produces all the board documents for you.
And exactly, and there's a suite of just really easy template documents there as well. Like if companies come to us and say, "Will you take care of your company's books?" I'm like, "We can do, but we're just going to use this website. So feel free to use it yourself." Saves you a few fees, and it really does just get everything in order. Plus, when you come to an investment round, you can just hit download company registers, and it gives you the full historical register of members, register of directors, everything. So CapDesk and Inform Direct. Inform Direct I'd strongly recommend. I wish I could get a referral fee from them, because I recommend them every time I do this.
Okay, so I think we're there on the questions. So thanks again, Bill, for a brilliant session. We've had lots of great positive comments. Thanks a lot, Bill. Great session. Great, thanks. We'll be in touch. That was great. Excellent. Thank you. Informative. Honest answers reseed legals. Well, that's what they say. Honest lawyers. That's what we are. So
absolutely, yeah. No, like I said, I think they're a great product. And the more companies that are raising, the more companies get to the next round, which is us. So always good things.
Yeah. Well, thank you everyone for logging in. As I say, would love to see you at one of the other EC events. So please do come check them out and reach out to me. And please do reach out to Bill if you're doing any fundraising, and pick his brains. Thanks a lot, everyone, and good night.
Thanks, guys. Thanks so much. Cheers.